With that, Mr. Saluzzi, you are recognized for 5 minutes.
Thank you, Chairman Eisenga, Ranking Member Maloney, and the members of the subcommittee for giving Themis Trading the opportunity to testify on this important topic. We want to applaud the subcommittee for taking the time to examine and question the functioning of our equity market structure, even in this time of relatively low volatility, when complacency can sometimes take hold. We believe the time to be asking tough questions is exactly now, while the market is not under stress as it was in 2008 through 2010. My name is Joseph Saluzzi. I'm a partner and co-founder of Themis Trading. We are a no-conflict institutional agency broker. We do not make markets. We do not trade proprietarily. We do not own a dark pool. Our only business is providing best execution for our institutional clients. We are agents for long-term investors who collectively manage well over $1 trillion of long-term investor funds. My partner Sal Arnick and I started Themis Trading in 2002 to leverage our expertise in navigating the electronic landscape of trading. In the 90s, we navigated an environment in which regulators tried to rectify many of the problematic features of market structure at this time. NYSE specialists had engaged in imperfect activity. NASDAQ market makers colluded in keeping bid-ask spreads artificially wide. In Themis, we hope to grow a firm that utilized electronic tools to source liquidity for our clients and in the cleanest and natural ways. By the mid-2000s, we recognized that there was a new equity market structure forming, with a multitude of ECNs, dark pools, trading venues, which was evolving in especially troubling ways. Complexity was rapidly increasing. A new breed of short-term high-frequency trader was rising, a breed that evolved from many of what you would call were the SOES bandits of yesteryear. These traders were becoming the dominant form of liquidity in our markets, with business models built around arbitraging faster and slower quotes on different venues. These firms realized that seconds, milliseconds, and now microseconds mattered, and they realized to capitalize on their proprietary trading arbitrage, they needed the tools which were supplied by the stock exchanges, such as colocation, special order types, proprietary data feeds. I'll try not to get into all the jargon, but there's a lot of it, and the details really do matter here. In our efforts to improve our trading for our clients, we began investigating under the hood how the stock market really worked. We expressed our concerns to our clients, to our regulators, to the industry in general. We also began sharing our concerns publicly. We wrote white papers. We have a Themis Trading blog that we run fairly actively now. We're active on social media. In other words, we're not quiet participants in this market structure debate. Our first white paper was titled Toxic Equity Trading. It was written in 2008. It's 2017, right? So we're still talking about this stuff. In 2012, we summarized our findings and published a book called Broken Markets. While not quite Flash Boys, we didn't sell as many copies. We think the material is very important. Sadly, many of our concerns that we highlighted in the book are still a problem today. Today's stock market is comprised of 13 stock exchanges, 12 active of those 13, 40 alternative trading systems. I won't bore you with all the details. You get to those later. But the problem is that they're not regulated with the same disclosure and the same practices yardstick. The fragmentation, which escalated after the SEC passed Reg NMS, is the source of most of our problems. While the SEC believed that Reg NMS would create competition among the stock exchanges, we're certain that they did not anticipate that their regulations would have resulted in a high-speed competition to trade against long-term investors. And we hope that the SEC didn't think that all this fragmentation and complexity would be a desired result. And I think most of my panelists in the next panel would agree that what we have right now is not what the SEC intended. Our modern markets are built on high-speed races around a fragmented web of liquidity. Our primary concern is how the stock exchanges have changed over time and since they become for-profit venues. Quite frankly, we think they've lost their way. They are no longer impartial referees, but instead are now players in the game with a vested interest in the outcome. Two exchange practices, which I will get into later, which are particularly harmful, we think, to investors, are one, like Mr. Lyons said, is the maker-taker rebate model. This is the source of many conflicts of interest. And the second is the proprietary data feeds. And we'll get into that later as well. I'm running out of time. Our written testimony also covers other main concerns, which include dark pool disclosures, broker order routing disclosures, market maker obligations, payment for order flow for internalizers, the role of academic studies, which needs to be questioned, the revolving regulatory door, which needs to be questioned. So quite frankly, I've explained a lot of issues with our fragmented market structure. It's conflicted, it's complex, and it would be naturally and competitively less so if regulators would enact only some common sense reforms. We don't think an entire holistic review is necessary. Things like eliminating payment for order flow and reducing and restricting some of the information that's coming through these proprietary data feeds can go a long way in solving the fragmentation and the complexity that we have. With that, I'd like to thank you, and I look forward to answering your questions.
Appreciate that.